say thanks so much for joining us. It's great to have you with us. I'm Amy Akmoody. I'm an associate advisor here at Flagstone, joined by our founder and senior wealth advisor, Michael Johnson, and our lead wealth advisor, Dan Staus. As you know, today we're talking about inflation in the housing market, and we'll also welcome any financially related questions at the end of our webinar. So feel free to type in any questions in the Q&A at the bottom of the bottom toolbar. And finally, I'll just add a disclaimer that Flagstone is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. And investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to consult with a qualified financial advisor about any strategy discussed herein, and past performance is not indicative of future performance. And with that, let's get started.
Great, thanks for the introduction, Amy. We're going to talk a little bit about, as you read in the invitation, if you're watching this live, or as you may be reading the description if you're watching the published version, we're going to talk a little bit about housing, what's going on in the housing market right now, a little bit about inflation. Those two things are kind of related to each other. So we'll start off by talking a little bit about what's going on in the housing market. And we'll talk about some of the causes and effects. Then we'll transition into inflation and kind of wrap up our thoughts on those things. So Amy's going to share a presentation here. We've got some charts that kind of speak to all of the different things that are going on in the economy that are related to these specific issues. So
is it up, Dan?
Yep, I can see it. It
Great.
Looks like, yeah, let's go to advance a couple slides here. So this slide is talking, we're going to start with some of the causes behind what's going on. So when we are thinking about the housing market, a common thing to consider is how much inventory is out there right now. How many homes are for sale, whether it's new construction or existing homes. So this shows how many months supply of inventory are out there right now. And the latest data point is from May, and that was at 5.1 months, which is lower than average. So the average has been 5.7 dating back to 1990. So we're a little lower. You can see like at the bottom there, just a few months ago, it was significantly lower than average. We've had a little bit extra supply recently, which has helped. And we'll stay on this slide, but in addition to the low supply, we've had high demand. So there's been a shift to remote work lately in the past 15 months because of the pandemic that accelerated this work from home mentality that a lot of companies have. And so that's causing a lot of people to rethink their housing situations. There's city dwellers who are moving out of apartments into houses for the first time. There's people from San Francisco and Los Angeles who are moving to less populated areas, and they're buying homes that with their San Francisco salaries, they seem super cheap to them, but it's causing more demand in those local markets, which is having an effect on prices. And then there's a lot of millennials who have delayed home purchasing until now. They've been in the workforce for quite a while now. They may be financially in a position to purchase a home, which they had been delaying for a while, and so that is contributing to high demand as well. And then on the next slide, we'll see that low mortgage rates are also affecting the demand. So we're a little bit above the pandemic lows of springtime last year, but we're still really low from an interest rate perspective when we think about historical standards. So this one goes back to 1990, but if we had a longer term chart, you'd see similar trends. So we have low supply, high demand, low interest rates, and if you go to the next slide here, we'll see that that's causing housing prices to rise to record levels. This is a S&P Case-Shiller Index, which you don't really need to know the technicalities. You just look at the trend. You can see that going back to 2000 to now, prices are extremely high. compared to what they were. So you can also see in 2007, 2008, there's that housing bubble high, and then the fall off that we experienced with the global financial crisis. So one of the questions people ask when they see this is, are we in another situation like we were back in 2007, 2008? Are we going to repeat the financial crisis? And so I wanted to bring in Mike to kind of speak to his thoughts on that.
Yeah, I mean, during that 07, 08 time period, it was, like often is the case, there were similarities to now, but it was also very different in the way that mortgages were being offered to people that had not a lot of credit, poor credit, and then they would be packaged with other loans and sold off in secondary markets that just made them look better than they really were. And so when that whole system started to collapse, it really caught momentum, and one of that collapse tends to lead to more collapse and more collapse, and that's really what happened in the housing market. When the dust had settled, there were a lot of changes related to the regulation of mortgages and how you qualify, and a lot of the subprime mortgages, which were the higher risk mortgages, went away. I think permanently, although there's still some options for lower credit borrowers to buy houses. But I think that has changed a lot. So I would not expect a similar kind of thing to happen in this housing market that happened in 07, 08. Just we were talking offline before this, there are always risks out there that we may not see. In 06, there were a few people, if you watch the movie The Big Short, that saw some of that coming, but most people did not see the risk of the subprime mortgage. And so, sometimes the worst, or I shouldn't say sometimes, all the time, the worst risks are the ones that you don't see coming, because if you see it coming, you can sort of price that into things. And so we don't want to say that this housing market will be just fine and keep going up, because you never know. But I don't think the same thing that caused the 07, 08 collapse is going to happen this time. I do think there are markets where we could see prices go up and then kind of come down. I mean, the Lincoln, Nebraska market where we're at is pretty steady Eddie, but you get to places like Phoenix or Denver maybe, or Austin, or some of those places where it's really crazy. And I think that that could settle back down. It's hard to say how that happens, but I could see some price volatility in those cities more so than some of your more steady Eddie Midwestern type cities.
So do you think that it's, for someone who's looking to buy a home right now, do you think it's unreasonable to even be considering that right now? Should they wait it out? Should they, what should they expect, or what should they consider when making that type of decision?
I mean, to me, for people that are selling a house in this market and buying a house in this market, outside of the timing of those two purchases, I think you're going to sell high and buy high probably in terms of prices. I think if you are a first-time home buyer, for example, I probably wouldn't be afraid to rent for a little longer. If you're not selling something and you're trying to buy for the first time, I wouldn't feel like you have to rush into buying a house. Home ownership is a great thing that happens in America, and it's created a lot of wealth for people. But I think sometimes people assume that you just have to own a house, and that's not the case. So if I was a first-time home buyer, I probably would rent for another 6 to 12 months and see how the market is. I think rates will continue to be low, maybe not as low as they are now, but I think they'll continue to be historically low for a little while yet. At least the Fed has indicated they're going to try to keep interest rates low. The government really benefits from low interest rates because we borrow a lot of money. So I think there's a lot of incentive to keep interest rates low going forward. So I would probably be patient with buying a first-time home.
Okay, thanks for that. So the next slide shows kind of an effect, somewhat of an effect on housing starts, so new construction. So a lot of the economic activity and the increasing demand paired with an increase in prices is creating more incentive to build houses for home builders to build. And so you can see that here. We had a housing start low in about 2009-ish, and we've been on a steady increase since then, ignoring the kind of blip there from the spring bear market, that spring 2020 bear market. So we're a little higher than average right now. This, more housing starts does put downward pressure on prices, but there are so many other things happening right now. Like Mike said, rates might be low for the foreseeable future, and that could keep demand high and keep prices high. And then all the other economic factors causing high demand could really more than offset any supply increase from housing starts. So this might help a little, but it might not do much, I guess is the bottom line there. So the next kind of topic here is, how does this relate to inflation? So we're going to talk a little bit about some of the economic factors that have led to inflation. You can see the GDP, which means gross domestic product. It's kind of the measure of the economy in our country. And you can see the major negative GDP there in the second quarter of 2020, negative 31.4, and then the big recovery the following quarter. Most recently, we have final numbers on Q1, which was 6.4%. That's well above the historical average of 2.8%. So the economy is definitely on the rise right now. The next slide kind of speaks to that as well. These are a couple of different economic activity indices, which show that non-manufacturing and manufacturing activity levels are such that an expansion is happening. We won't spend any more time on that, but it's just more evidence to show that economic activity is on the rise. Couple more that kind of same conclusion. Travel activity is up. We're almost to the pre-pandemic travel numbers when you look at TSA, airport security checkpoints, how many passengers are being screened. And then the next slide shows restaurant activity has increased quite a bit. And depending on the region, some states have more restaurant activity than they did pre-pandemic. So that's some encouraging news on the economic front as well. And then on the next slide, we'll see that, okay, all of these things that are happening have led to increased prices. When more people are consuming things, prices tend to go up. There's also monetary policy that's happening that is causing prices to go up. But when you look at this CPI, and the core CPI is kind of a number that smooths out the effects of food and energy. So a lot of times economists will focus on that core CPI number, and that's 3.8, but regular CPI 5.0. The question that a lot of people wonder is this higher inflation going to be a more longer term thing, or is it transitory, meaning is it a short-term thing as we transition out of the pandemic? The Fed chair has gone on record for saying he thinks it's transitory. There are other smart economists who think that there are some things happening that would lead it to be longer term. But I'm curious, Mike, if you have any thoughts, or what have you been hearing with regards to, how long this inflation might last?
Yeah, I mean, I read a lot about different things related to inflation. And I tend to take more of the Fed's view that I think we're in this odd supply and demand imbalance because of supply channels that sort of got out of whack because of the pandemic, and some changing behaviors because of the pandemic. And so I think that will eventually smooth out a little bit. However, I read a piece recently actually it was a video by Dimensional Funds, Eugene Fama, and he kind of said when inflation comes, it tends to stay for a while, a little longer than one thing. So if I was going to guess, and again, this is just a guess, is that we go through a year or two of this, probably closer to a year of this odd supply-demand imbalance, where prices can be really goofy for a period of time. And then we settle into something that's maybe higher than it has been in the last 10 years, but still not ridiculously high. So that would be my guess. But again, nobody knows, and there's not a shortage of opinions on the topic. So,
yeah, I think it's a good illustration of the fact that we don't know how long it's going to happen is good reason to, with your investments, if a diversified portfolio can withstand certain things like this, it's designed to do that. So we don't really try to form an investment strategy based on, hey, I think inflation is going to be X number over the next 12 months. And we really focus on bigger picture things like someone's goals, someone's appetite for risk, those types of things. So, and you touched on something that I should have mentioned earlier. I talked a lot about the demand side of the equation, meaning there's a lot of increased economic activity because we're coming out of the pandemic. But you mentioned that there's the kind of a supply shortage right now, just because the global supply chain is so messed up right now, and that's similar to the housing market. Low supply combined with high demand, and either one of those things causes prices to increase. And right now we kind of have both, so it's magnified by that. Amy, if you want to go to the next slide, we can look at, okay, what does this mean for the markets, specifically the stock markets? Well, positive economic activity generally leads to strong corporate earnings. So companies are making more money, and positive corporate earnings tend to lead to a rising stock market. So you can see both the shaded area, which indicates earnings per share, how much companies are making, and then the line there is the S&P 500 index, a stock market index. Those are pretty closely correlated. So so that we can sometimes have good news that comes out of this for the stock market. If we go to the next slide, while there are some stock prices might seem high right now, we're constantly hearing, this index or that index hit an all-time high, and that causes fear in a lot of people. But there are areas of the market that have more attractive valuations. So maybe Mike, you could talk a little bit about that concept with this slide.
Yeah, so the little diamond on this chart represents the price to earnings ratio, and the price to earnings ratio really is just how much do you have to pay for each dollar of earnings. So if I have a lemonade stand and I make $1 a year and I have to pay $10 for it to buy that particular lemonade stand, the price to earnings ratio is 10. If I had to pay $25 for that dollar of earnings, the price to ratio is 25. And so on the right-hand column is this price to earnings ratio going from 35 at the top down to 10 at the bottom. And so you can kind of see which areas of the market are trading at lower price to earnings ratios than other areas of the market. So we see large value is trading for 16.9 times earnings. And you have mid-cap value stocks at 15.7. You have small value at 16.6. So those are, and generally speaking, if you buy a stock or a basket of securities at a lower price to earnings ratio, your forward-looking returns tend to be better. Not always the case, and price to earnings ratios can kind of give you some head fakes. So it's not the end all be all, but that's the general rule. On the left hand of this side of this chart, we have earnings per share growth estimates. So how much is that particular basket of stocks expected to increase their earnings? And so ideally what you want is a sector of the market that has a low price to earnings ratio, but high earnings expectations. So it's selling cheap relative to the earnings, and the earnings are expected to grow by a bunch. And so I guess the shining star in this chart is the small cap value, where earnings expectations are up around 34% growth, but trading at a 16.6 times PE. There are others, large value looks pretty good, mid value looks pretty good. Probably the worst looking on this particular chart is the large growth. You can see how it's trading at 27.8 times its earnings, but only expected to grow those earnings at 15.3%. Again, we don't use this information to try to put all of our money in small cap value, for example. We're going to have exposure to all these things, but it's just instructive, and we do tend to tilt the portfolios towards value. And so we think that our portfolios are positioned well for the future.
Great. And then the final slide here, maybe Mike, you could cover this one too, just about, maintaining an optimistic view.
Yeah, I mean, that's one of our core investment principles is optimism. There's always not just one thing, 10 things, 10 reasons why it's tempting to get out of the market or try to time the market or think, oh gosh, stock market's high, I better get out now and then I'll get back in when it's lower. And we just know from experience that that's not how it works. People don't do that successfully. You have to be right twice, and usually people aren't even right once. And so we take the approach that to have optimism in how we think about things. Doesn't mean that we're naive that bad things can't happen, but by maintaining an optimistic approach to investing, by believing in the capital markets, by believing in business, we can overlook or at least tolerate some of these things like the tech crash or the housing crash. We use that as an opportunity instead of something that scares us. That's when we rebalance your portfolio. We take some of your safe assets and we buy some risk assets, or you utilize some of your earnings or cash that you have at home and buy things after they've been beat up, with the belief that, and history has illustrated that over time, that's going to keep on marching in the right direction. So that's really how you generate wealth over time in the stock market.
Awesome. Thanks for that explanation. That does it for our prepared remarks. Amy, I'm curious if we have any questions from folks that we could answer.
We do have a few questions. I'll start with one that asks, you mentioned waiting to buy, but would you have any advice for first-time buyers on a loan?
Like on the mortgage side of things? I mean, there's certain.
It sounds like it. Yeah, it sounds like it.
Yeah, there's certain mortgage products that are geared towards first-time home buyers. I'm not a mortgage officer, so I'm not necessarily an expert in that. I will say, piggybacking off of Mike's comment to be patient, I think that has done a lot of people a lot of good, not just with buying homes, but with delayed decision-making and delayed purchases for various things during life. That can tend to be a good way to build wealth. But Mike, I don't know if you have any thoughts on that specific question.
I don't know if this addresses it specifically, but when I have seen people selling houses in this market and they're getting multiple offers, the sad reality for a new buyer is if they come with a NIFA loan, or I don't know if that's a thing anymore, but a loan that is like a government program loan for first-time buyers, their offer to buy that particular house is just going to be looked at much less favorably than somebody that has cash or is using a conventional mortgage. So I think not only are prices high, but I think overcoming a less desirable offer is going to be really hard. And so that's going to push people to even offer more. So I really think that if I was doing it, I would be patient, and I probably would be comfortable renting or doing something different than trying to chase this hot market if I'm a first-time buyer. I don't know. Unless she found the right situation, unless she found maybe a buy owner or something that is attractive compared to other things out there, or maybe less known than other things out there, I don't think it's a great time.
Yeah, to qualify for some of the traditional loan types, mortgage types, typically lenders require 20% down. So if someone can get to that level, then they're going to be able to qualify, more likely to qualify for conventional mortgage, which will not be looked at unfavorably by a seller. I saw someone commented, you've talked a lot about first-time home buyers, but not really about someone who has an existing home looking to move. Do you have any advice for those buyers? Mike kind of mentioned earlier that, well, if you're selling and buying in the same market, then you're going to be selling high and buying high. There is kind of a caveat of, if you're selling a $200,000 home and you're buying an $800,000 home, that's, the effects of that are different, or vice versa, could be to your favor if you're downsizing. But I don't know if, Mike, you have any specific suggestions for people who are changing houses?
I think it's best if you can match the timing of those pretty closely. So if you're kind of agreeing to buy about the time you're selling, so especially in a market like this where things are kind of going up and down quickly, I think that is favorable. And I agree with what you're saying, Dan. If you're selling a $200,000 home and buying an $800,000 home, you're effectively buying in a really frothy market, probably. But ultimately, if it's it's the place you're going to be in for 20 years, again, I wouldn't sweat a few $1,000 here or there, or even $100,000 here or there, in terms of differences in purchase price, because in the long term it'll be just fine. But I do think the first time buyers are the ones that you really have to be worried about, and then the ones that you can be excited about are people that are selling into this market and not having to buy another house with those proceeds. So there are opportunities to win and lose in this, but I think the people that are buying and selling, as long as the timing is somewhat matched up, I don't think there's huge amounts of risk. And then you're going to be able to lock in low rates. If you're borrowing on that new house, you're going to be able to lock in low rates for the next 20 years, which is a real benefit.
All right, thank you both. There's another question that asks, is there a general rule of thumb is there a general rule of thumb for a house I can afford based on my income?
Yeah, Mike, you always cite that.
I always say 2 to 2.5 times income is sort of a house that is reasonable. Now that the problem with rules of thumb is, they're just rules of thumb. So if you have not a lot of income, but you have significant assets, that might be a different rule of thumb. If you're early in your career, have high earnings, but you have credit card debt or school loan debt or something that's kind of a drag on your financial situation, 2.5 times probably isn't a good sort of rule. But I think that's a good general rule of thumb, that will stop people from buying too much house. Because the problem is, if you have a good income, a lot of times you can qualify for a lot of house. And people, especially in 07, 08, I saw people, or 06 probably, I saw people qualifying for more house than they could afford. And that got some people into some trouble.
Yeah, some of the other rules of thumb out there lenders will approve you for are just kind of ridiculously high. Debt to income ratios of 40%, housing ratios of 32%. I mean, and that's using gross income. It's kind of a gross simplification of how much house someone can really afford. So we'd encourage you to kind of take a little more closer look at your situation before just going with whatever the lender approves you for. We have a kind of a comprehensive analysis that we can do for clients that looks at home affordability. There's a lot of math to that, but then there's also some art to it as well, figuring out, does this make sense from some non-numbers related perspectives? So we'd be happy to help people think about those factors. I think it probably gets us close to time, maybe, don't you think?
Did you say time, Dan?
Yeah, it probably gets us close to time
Okay, would you mind answering one more question that just popped up?
Yeah. Oh, yeah,
That
sure.
is, why is significant school loan debt, such as someone with a professional degree, such an impediment to securing a mortgage loan? I think that might reference something that.
Yeah, that's probably something that I reference. I'm not saying it's such an impediment. I just think it's a factor of one's overall situation. So if I have to, spend $1,000 a month paying back my school loans, that's less cash flow that will free me up to spend on a house. So if you're using a rule of thumb of 2 to 2.5 times income, but I have these other debt payments that aren't really calculated in that rule of thumb, I have to consider those things. So that's really all I meant. Dan was talking about our view on that stuff. I really think it's important if you're worried about it, if a person's worried about it, our financial planning process gives us a view of your whole situation, your debt, your assets, your income, all those kinds of things. And as Dan said, there's a lot of art that goes into that. And there's a lot of understanding the people and their spending habits. And, are they always extending or are they always paying down debt early? Those are different people. And we can kind of use that data along with the hard data to try to suggest what seems reasonable or what doesn't. So it's usually pretty clear, honestly, when we look at the whole picture of is this particular house or situation going to put them in a bad spot, or are they the kind of people that are going to make it work just fine and it's not going to be an issue for them to buy this whatever house is being proposed.
All right, great. Well, thank you both. Is there anything either of you would like to add as a final note?
I don't think so.
Okay, all right. Well, again, thank you for joining us. We'll hope to see you next time at next month's office hours. Have a great weekend.
Thanks.